Good afternoon, everybody. Welcome to this ACT webinar, Hedging FX is Changing. My name is Peter Matzer. I'm the Engagement Director for the ACT, and it's my pleasure to welcome you to this conversation this afternoon. A couple of housekeeping points for those of you online. If you have any technical questions, for example, if the sound does not work, you can get some help with this by pressing the green icon and typing in your question. You will be answered by the service provider. You can also ask questions of us conducting the webinar through the Q&A box next to the media window. I'd remind you that the webinar is going to be available on the ACT website from early next week, so you can remind all your colleagues that if they want to listen in and haven't been able to do so today, they can do so then at their convenience. I'd like to thank CME for being our sponsor today, and I'd also like to thank Paul Teidemann from Intertek from coming along and speaking from the corporate treasurer perspective. I'll introduce those for you in a moment or two. There's a slide on your screen talking about the interactive widgets, which I think is relatively self-explanatory. I would just draw your attention to the fact you can follow the ACT on Twitter at ACT Update, and you can tweet live during this webinar using the hashtag ACTWebinar. Please do so and join in the social media conversation. I'd like to introduce our speakers to you this afternoon. We have Sandra Rowe, who is the Executive Director, FX and Metals Research and Product Development from CME Group. CME is the world's leading and most diverse derivatives marketplace, offering futures and options products for commodities and financial risk management for all manner of institutions and corporates. Paul Teidemann, who is the Assistant Treasurer of Intertek Group PLC, is joining us as well. Intertek is a quality and safety inspection business looking after products, processes and systems across a huge range of industries. I'd like first of all to ask Sandra Rowe to speak to you with her presentation.
Thank you, Peter. And welcome and hello to everyone who's on the line. Thank you for listening to this webinar. And I'd like to also thank the entire ACT team for putting this webinar together today. I'm here to talk to you about the FX hedging landscape from a infrastructure provider point of view. And I want to just take a few minutes to talk about CME Group for those who are not already familiar. CME Group itself is an amalgamation of a number of different platforms or exchanges. We have merged, so CME stands for Chicago Mercantile Exchange, which merged with the Chicago Board of Trade back in '06, and then subsequently merged with NYMEX and COMEX out of New York. CME Europe is a London-based exchange regulated by the Bank of England and the FCA, which was launched last year, April 2014. These are the various exchanges that we operate, as well as numerous partnerships we have around the world with other local exchanges. For those who have maybe heard about Globex, that is basically our trading engine. Globex is known worldwide for its 24/7 operation. It has been developed over a number of decades to basically provide the exchange-traded derivatives platform that operates all of these exchanges that I've just mentioned. CME Direct, you can just think of that as the link into being able to trade and see pricing of all of our products. It's the GUI of our platform. And we have two clearinghouses, CME Europe, obviously in Europe, and then we've got CME Clearing US, which has been around for many decades. In addition to that, obviously because of regulatory changes, we have launched global trade repository services alongside a number of other institutions that have launched trade repository services for required trade reporting. We have ability to service clients in Europe, US, and Canada. I think the easiest way to think of CME is to think of us as not only a financial services provider, but actually a technology firm. The core of everything we do is technology innovation. And we strive every day to innovate from a technology standpoint as well as from a product standpoint, which I'll talk about a little bit more specifically to FX hedging. Taking you to the next slide, and obviously the meat of the conversation that we're going to have today. The FX landscape is undoubtedly changing, and I think we all know that, and the banks more so than anyone else. We have seen it also from our side. We have seen the unbelievable amount of regulatory pressures coming down, predominantly from our bank segment, but also we as a regulated entity are also subject to a number of these additional requirements. We spend a great deal of our time making sure that we are compliant around the world. No small feat for any of those who are obviously trying to operate in a global marketplace. In addition to that, I think what we are seeing is positive shifts in the market. Some of the shifts that are changing are actually quite good for end user participants. That includes technology-driven innovation where pricing is transparent, where trading is faster, it's cheaper, and then there's more market data to look at how trading occurred or executions have occurred. I think the level of transparency that is now available today versus, let's say, 5 years ago is actually a positive thing for the end user. We can talk a little bit more about some of the challenges to that, but I think if we were going to put a positive spin on what is going on, I would say that there are some absolutely positive outcomes for increased hedging alternatives as well as choice for clients, and also in terms of transparency, the ability to see where you've transacted at that moment, and then to be able to actually do TCA or trade cost analysis around that. One thing I want to highlight in terms of changes that we are still working through is obviously around FX pricing and benchmark bills that have come up in the last years. I think there are a number of issues around the benchmarks which are being dealt with by the regulators. And as some of you may know, WMR has the 4 p.m. benchmark has actually come under FCA regulatory oversight as of April this year. However, I think there's still questions about a rethink, not only in the U.S. but also in Europe and Asian clients about are these benchmarks sufficient? Do we need alternatives, or has the problem been solved? And I think I leave that to the audience to decide or to opinions around that. So there are a number of challenges that we're facing. I think one thing where I would like to focus is just from a Treasury standpoint, and this is probably where a lot of treasurers have not typically looked, is exchange trading and electronic trading. There are benefits. There are definitely downsides as well. I'll cover that. But I want to just talk about some of the benefits, which obviously cover anonymous trading with pricing and transaction cost transparency. I will show some slides on what I mean by that. There's a diverse client base. We have a diversified liquidity pool. I think one of the things that's unique and surprising to a lot of people is that banks represent less than 10% of our overall liquidity pool. We have an amalgamation of asset managers, corporates representing actually our smallest client segment. So I don't want to overemphasize the corporate pool because I think that's still growing and yet to develop. But we do have pension funds, hedge funds, proprietary firms. There are a number of different players in our space, which is unique. We may not represent a huge portion of the OTC relative volume, but that liquidity is growing. It's concentrated in select dates, which I know is a bit of a problem for certain corporates that need specific bespoke dates. But we are, I will talk about that a little bit later in another slide about how we're going about addressing some of those concerns from a corporate treasury standpoint. But we do have the liquidity there on the dates that we do offer. And further to that, we offer end-to-end services. Certain exchanges offer the full body of trading, clearing, settlement, and reporting. Obviously, others don't, but I think for those who are offering FX services, many do offer that end-to-end servicing. Just to give you a snapshot of what I meant by the pricing and transparency is this is a snapshot from our CME Direct screen, and we've got EUR/dollar here. I've got dollar renminbi down below. Let me just focus on the top half first. So the EUR/dollar screen just shows you the bid offer, and then we've got quantity to the left and to the right. Now here in exchange world, we talk a lot in contract size or versus lots, which is the size of the contract because everything is standardized. So just at the bottom, I've got 100 EUR/dollar contracts equal to approximately $14 million. And then 10 US renminbi contracts equal to approximately $1 million, just to give you a sense of notional numbers, values. The screen here at the top really showing you the depth of book, which is basically the liquidity that's available of those pricing and market making and to anyone who wants to basically lift either side. So if you needed to execute a certain amount, you could get done knowing what kind of spread you would be looking at. We're looking at a pip wide on the first level. If you needed more, you're looking at 3 pips on the second level, and so forth and so on. Now, obviously, if you look down at dollar CNH, you can see we offer spreads that are a little bit wider in smaller size, but you would expect that, or we expect that in our obviously emerging markets, our notionals are going to be smaller on offer and spreads are going to be slightly wider. But these prices are fully available real time. And transaction cost transparency. This is on our website. Our prices don't change very much. They do differ slightly for our market makers, and if anyone has any questions around that, I'm happy to take that offline. But for the average customer who comes in, these are the prices. They don't change, or at least they change infrequently. And that is what exchanges do rely on is the fact that everything, your costs, your pricing, everything you do is known upfront. And that is something, that sort of certainty of what something is costing you, we think is a benefit. Now, on the next slide here, I'm just showing you some volume numbers. I think a misnomer with a lot of folks in the market who are traditional OTC FX users is that somehow the exchanges have no liquidity. In emerging markets, absolutely, we're going to have patchiness in terms of liquidity, but in this environment, I think emerging markets is a tough place, depending on what you need to do anyway. But I think what I really want to highlight here is the fact that in Eurodollar futures, actually the majors across the board, we have incredible liquidity, upwards of $100 billion a day. So if you needed to get even a couple $100 million done, it's actually quite easily done in the FX futures market. And you could see we've taken a hit, obviously, like everyone else during the financial crisis in 2008. And we had some very big spikes, primarily driven by the Eurozone crisis during various pockets of the last few years. As you can imagine, volatility drives volumes for us. So the last few months have been quite volatile. And then further to that, just FX options. We have seen actually it's been a very big bright spot for us. Obviously, the notionals are much smaller, but we are looking at close to 12-13 billion a day US dollars of notional value being traded, predominantly in our majors. And then one other point I'd like to make, just from a CME data standpoint, is this is public information. We actually have to report this to the CFTC every week, and it is basically our report of those holding individual institutions holding 400 contracts or more equivalent, which is about $60 million in the majors, or holding $10 million equivalent in emerging markets. Here we have 712 individual large open interest holders. So in exchange world, open interest represents those holding a position. So these are the hedgers. These are not the people churning or speculating. These are people actually holding their positions for a certain period of time. Now, we've seen absolute tremendous growth in the number and diversifications. This actually goes to diversification point that I was trying to make earlier about more and more different types of clients coming in. And just last month, I got this number today, 990 was our record last month in terms of large open interest holders in FX futures. So that number just keeps growing. And again, public information we submit to the CFTC, so you could always keep track of that for yourself as well. And I leave you with a couple thoughts on why you should start looking at exchange traded as a hedging alternative. There are a number of things that obviously available today that may not suit. However, we at CME, at least, again, I can speak only for CME, we are looking at expanding our product suite to meet the needs of the corporate and asset management client base. We are looking at expanding tenors. We do need to strike the balance between offering every day, which would have sparse or no liquidity, and concentration of liquidity on certain settlement dates. The reason why people come to an exchange is because they know they've got guaranteed liquidity on the dates of those settlement dates. So we need to make sure that we keep that balance. We are looking at everything from weeklies, monthlies, and dailies. We do have dailies in the emerging market, we've got monthlies in the emerging markets, but we definitely have been asked to, for example, provide end-of-month settlement. We are listening. We are looking to do that. Another point is increased participation down the curve. We've got what I call open interest down 4 years in Russian ruble. We go out to 5. The Russian ruble crisis has actually prompted a lot of former OTC FX hedgers to come to us, even though we have margin and they have to pay upfront margin. We have clients who've actually transformed their books from OTC FX ruble positions to futures. So we do have quite long-dated open interest right now, Russian ruble. And not known to a lot of people, but just to highlight here, CME is the administrator and calculation agent for a number of benchmarks, and we work very, very closely with respective regulators as benchmark regulation undergoes its own change. We are the EMTA CME Russian ruble benchmark reference rate. We are also the LBMA silver price reference rate out of London, and we have others as well. And then solutions to FX marketplace, we're constantly looking at ways to help clients hedge solutions, but as well as credit mitigation, counterparty risk mitigation, and settlement. We are looking at a number of different solutions that will help clients, and primarily targeted at financial institutions, including the banks, but we are working with various institutions to help come up with solutions that will work in a cleared environment. And finally, one thing to leave you with is a thought around is the vast number of resources available pretty much at our firm as well as any exchange. I do want to highlight there is a breadth and depth of information that is not readily available by a lot of other financial institutions, and I'm talking about certain market data. Not all market data is free. Some of it you have to pay for, but there is a wealth of information on our website. There's different links. If there are any issues or questions that you have, I think from an education standpoint, the exchanges do a very good job of providing information and be able to assist if there are questions. We have a customer service offering across any of the platforms that we offer, products that we offer, and we have specialists who are able to answer questions on a need basis. So please feel free to reach out. Please feel free to look at the website and explore, and if you have any questions, we're ready to help.
Thank you, Sandra. I have a couple of quick questions, not so much about some of the generalities of what you were talking about, but a couple of particular ones. In your graphs on the changes in volumes, there was a slow but steady progress in the early 2000s. Then we have everyone's nightmare of the financial crisis in 7 and 8, and then, by definition, a much higher increase in the volume of usage. It might seem obvious, but is it as obvious as to say good steady progress and then whoosh, a crisis, and then everybody thinks, how do we make this better value for us?
I would agree with you. I think, CME has had FX futures, might be surprising to some, since 1972. But it really did not take off until there was this sort of spotlight put on. The infrastructure was always there, but I think the spotlight was not really put on the benefits of futures until much later on. And I think U.S. players tend to be more familiar with futures than I think European and Asian market participants. So I will caveat, there are a few Asian countries where I think futures has a very strong place, like South Korea and Taiwan, which I find very surprising, but the pickup there has been actually quite good. But for the vast majority, if I am allowed to generalize, I think futures is a very new instrument. I think it's an unfamiliar instrument. And I think it will take some time for there to be the education and adoption. And maybe it won't be for everyone, but I think there are enough benefits there for it to be worth taking a look at.
That goes very briefly to my second question I was going to ask. You mentioned in your remarks about the growth of non-financial corporate users in your exchanges, and not solely in foreign exchange, but probably in the interest rate markets as well. Again, would that be a response to that financial crisis, or are you seeing some other issues at play other than the ones you've talked about in terms of operational issues?
Right. So when we define corporates, we also include our commercial clients, which are predominantly our energy-driven clients, and we've had those clients for quite a long time because of NYMEX, and they often cross over into our financial products. So that's a natural segue for them if those needs are there from a risk management standpoint. So we do have some natural corporates that fit into that space that have been with us for quite a long time. But having said that, we are beginning to see, because of some of the regulatory-driven changes and the pressures that I think banks have been under, and to be fair, to a certain level of customer segmentation that has actually happened at the bank level regarding if they're willing to give credit lines to them or they're not. I think we've had increased interest to look at futures.
Thank you very much, Sandra. We'll come back to you a little later on, I'm sure. I'd like to move on now to our corporate speaker, Paul Tiedemann, who's the Assistant Treasurer at Intertek Group, as I mentioned earlier, quality and safety inspection business. And Paul's going to talk through some of the aspects of foreign exchange management that they manage and look after at Intertek. And then obviously we'll be able to take some questions subsequently and bring both Paul and Sandra's comments together. Paul.
Okay, thank you, Peter. Thank you very much for giving me the opportunity to speak here, and thank you, Sandra, for a very interesting presentation. Certainly for one as a corporate, there's some aspects to changes there that are sort of new to me, so I should definitely be following up on those research links. My sort of presentation is a very brief gallop through Intertek's approach to FX risk management. These are the tools and the challenges and issues that we face in managing those risks. So sort of apologies if it's at a very high level. Our geographic footprint means that we have some interesting currency and cash management issues to manage. However, at the heart, our approach and the sort of tools and techniques that we use are fairly vanilla and conservative in terms of the products, the time horizon. So the burning question, who is well, we operate across a multiple of industry sectors. We sort of cover from sort of consumer products, minerals, IT, oil and gas, consumer products, food, agriculture. The list is endless. I mean, geographically, we operate along the supply chain for each industry, which means to say that we are in over 100 currencies, in 100 countries, 1,000 different locations. So it's a diverse operation. It's a diverse customer base. With over 200,000 customers, and the sort of top 20 customers, probably less than 20% of our total revenue. So from a treasury perspective, our policy is really sort of just looking to align with a portfolio of sort of small businesses, just trying to align with the management of those business structures. And as such, the diversified portfolio of services, it's not just the offshore branch of a large corporation. So that brings its own challenges as FX risk management. Just moving on, just a couple of quick slides, just sort of showing the revenue split that we're dealing with here. So we're in, it's approximately a sort of third split between Americas, Asia, and EMEA. However, out of that, I would say that over 70% of our sort of currency flows are in the G10 sort of dollars in Hong Kong. We tend to classify those as dollar-like, euro and sterling, with only sort of 30% coming into the other bracket. As a treasury centre, we are relatively light, and many others. FX, I mean, this slide is very busy, so please don't try and read it, but it's really just to show the number of different aspects that we're looking to manage. We're a team of 5, and we're sort of some of the activities are highly decentralized around bank account management, forecast, highly centralized on the others, such as managing our external funding. FX risk management sort of sits fairly central in the middle here. The mixers sort of centralized responsibilities that we provide, and along with the decentralized support that we take from the business and sort of country managers. So who are the investors for us? I mean, they are mostly UK and US based investors. They're looking to buy a global portfolio of global businesses, and as such a portfolio of currencies. So we take the view we don't hedge translation risk. We just let those sort of flow through. We tend to report on a constant currency basis, and that sort of flows through as a result of that. So what do we hedge? Principally, we sort of focus on the transaction side of it, a small amount on the pre-transaction. Strategic, that tends to come out through the business processes and the various sort of controls around those. If we're looking at the translation risk, the main focus, I mean, this is the receivables and payables each individual currency, so country. As a policy, we sort of say to the businesses that they need to hedge these. If it's sort of foreign currency, and we're looking to preserve the local currency earnings. That's the sort of the overall sort of framework. However, we also do take a view and we look at the different businesses. So, for example, we will place different emphasis, say, for example, on a business in Papua New Guinea, who may say have a sort of dollar receivables, compared to say sort of our investment in sort of China and India, which we regard as sort of key and very important markets to us. In that situation, if they have sort of dollar receivables which they're looking to hedge, then we will sort of look take that back in and protect their sort of cash streams in their sort of functional currency. In the case, say, of our sort of Papua New Guinea business, then we would probably let those stay in dollars. The translation risk, just one other thing to say on our sort of transaction exposures. Most of our sort of contracts are relatively short term, so it's repeat business. And so, as such, the time horizons that we're looking at is short. What we say, most of the sort of the period is the tail around the elections activity. The other aspect, a sort of complicating factor on our sort of business model, is that there's a lot of intercompany recharges where you will have the actual revenue being booked in one particular sector, for example. Say sort of Exxon or one of the oil and gas majors, the work and the intellectual capital, the payroll costs of them sort of being incurred sort of on a global basis. So one of the challenges is always managing and trying to identify those particular exposures and splitting out the company exposures from the true external cash flows. I mean, just touching briefly on net investments, hedging. We tend to borrow primarily in dollars and then lend down in local currency, and we will look to sort of match assets and liabilities on a local basis. coming on to the main products that we use, due to the typical nature of the business cycle and the revenue streams, we tend to focus primarily on outrights, forwards and swaps. As a treasury policy, we are able to futures and options. We are, I think, along with corporates, we are not able to write naked options. We use collars in that sense, but we will not receive premium as a result. To date, we haven't used any futures. Options, they tend to be restricted to sort of single ticket big events. So, for example, if we've got a merger and acquisition, sort of cash flow elements there that we will look at, then we will do so. For the most part, however, we're looking to hedge with outright. The main challenges that we find in actually sort of flushing out what the local exposures are. Sort of typically, we will only get to hear of it when there's an issue. Particularly, sort of we are. One good thing about the sort of recent currency volatility is we visibility of a lot more issues than otherwise be the case. We do have some tools that we use to sort of try and assist with that. From a policy perspective, we have the group treasury policy, which sort of sets out sort of in very clear terms as to what the expectations, roles, responsibilities are from the board downwards. And in addition to that, we have a supporting document which is called the Treasury Management Framework, which sort of covers two things. At one level, it's guide which sort of sets out what is an FX exposure, what is the sort of translation, strategic risk, etc. And another level, it also then sort of sets out what the responsibilities are for sort of group treasury in terms of managing those, but also then particularly important for the country finance managers, their responsibilities in identifying and sort of flagging out to group treasury what those exposures are. And I would say sort of the majority of our sort of time is actually spent in sort of engaging with the business and trying to actually understand what the flows are, sort of further complicated by the fact that the portfolio nature of the business means to say that there's no single ERP reporting system. So sort of the quality of the financial reporting information that we have is always a challenge. We have a sort of group consolidation tool, and for the most part, you're sort of look down one or two levels, but if you want to go down lower than that, then you've got to go back and reach out to sort of different finance managers. So it's always an ongoing thing for that. So just, I think, talking about product innovation, bring it back to the title of the webinar. For the most part, innovation for us is limited. The particular instruments that we're using are sort of very vanilla and they've been around for ages. I would say sort of areas that we have innovated, for example, where the banks are coming in, we have asked them and looked at sort of currency at risk. So we're looking at our overall portfolio, the cash flows, looking out over 4-year time horizon, using historic data, comparing that to our sort of borrowing requirements, and just to sort of put a quantum on the total value at risk for any realistic exchange rate movements. And the outcome from that pretty much confirmed our intuitive view. Floating dollars is our sort of preferred mix. And the typical quantum is also about the same level as we're expecting. What that means as far as we sort of manage our business and our net investment is, I guess, around some of the challenges we see on that would be around, say, the tax impact. So certainly from a consolidation point of view, we can borrow in dollars and we sort of lend down. That's fine, and that's still managed to finance sensitive. However, from a tax perspective, the gains and loss then booked in the sort of treasury entity, those are give rise to sort of real sort of tax gains and losses, which we have to sort of manage. So it's not perfect in any sense. One area which perhaps we're also sort of looking at, which we're seeing as sort of a significant sort of change and a real ramp up in volumes, is on renminbi. We have sort of significant investments in China. We now have sort of cash pooling structures in place that allow us to sweep renminbi back to London via Hong Kong on a sort of a regular basis. So that is mostly sort of through trade through the FX platform. There's other issues there, but I mean that's kind of sort of those are nuts and bolts of how the Treasury operates at Intertech. But thank you very much indeed for your time.
Thank you very much, Paul. I noticed in your board-approved instruments you do have the use of futures and options, and I wonder if you might be able to comment just a little bit more on the circumstances of using, or how you look at choosing to use those types of instruments, given some of the other challenges you laid out. I would also say at this point, this is the first time I think I've done anything for the ACT where people have used Papua New Guinea as their country of choice to illustrate a currency or any other sort of issue. So there's a first for you there. But I'm just interested in that balance. You've got your standard instruments, but you have the options, no pun intended, to use some of these other products. What thoughts would go through your mind in terms of, we'll use this one here, but we will look at using these other types of products in these circumstances?
Thanks. I mean, it tends to be driven more by the transaction or the particular event that we're sort of looking to address, and that would probably say tailor the type of instrument that we would have. So an example of that would be if we have a major acquisition, there's some elements of that around where there's some variable cash flows or the timing on the dividends, etc. And it's sort of very specific. So rather than actually looking at it from, say, sort of a product perspective, we're sort of coming at it from the sort of the problem that we're looking to address, and that would tend to dictate the solution that would fit.
I think the question, therefore, I'm asking is, you're obviously comfortable looking at these types of products to meet particular needs. So it's not an issue, if you like, of an intellectual position. It's a practical one. What works for us in a given circumstance?
Yes, indeed. I mean, I would also caveat that by saying it's also then what have we used before, and what can we then explain internally, and for us as a finance team and everybody else then to sort of report on, etc. So it is easier to use those products that we've used before rather than sort of bringing new products into the mix, unless there are, say, a strong and compelling case, that they give specific advantages over and above, say, sort of existing products. And I, again, use the example there of, say, comparing options with say, futures.
Sandra, there's a classic play, therefore, from a treasury position, and you mentioned some of that in your context about the growth of corporate users on your exchanges, particularly here in foreign exchange. Maybe you could expand just a little bit on that in terms of how you're seeing that growth. What sort of attitudes people have when they come to you and say, "Can you help us with these types of issues?"
I think one predominant challenge is obviously understanding how and what a future is. How does it work versus the traditional forward swap? So we do have lots of tools to get over that hurdle. And the second hurdle tends to be, well, I need to have that buy-in internally. I need to present that case, why it's better than my traditional. And we have a number of different compelling points I think we can make as to the cost, transparency, efficiencies around using futures. It's another tool. I mean, I'm certainly the last person to say it replaces all futures. All forwards. That's ridiculous. It is another tool. And if you have another tool available, why wouldn't you go and investigate at least what it is, and does it apply and work for you in your set of risk management responsibilities? That's my immediate question to folks who put up a little, questions around that. The third challenge I think a lot of people have is, let's say they convince internally, everyone's on board, everyone understands, and let's go and do it. Well, there are technology hurdles, and I'm certainly not going to say that there isn't a certain amount of technology work that is involved to get there. The good news is that we've got a lot of tools for free, at least from taking a look at the pricing standpoint. Now, the trading connectivity piece is going to take some IT work, no doubt about it. But luckily, that's getting easier and more efficient as days go on.
There is some evidence that suggests that using exchanges has its values in less traded currencies, in emerging markets, less liquid currencies. Ironically, in the sense that because they're less liquid, you need to go to the places where what liquidity there exists, whereas in the traditional banking market, perhaps that's not the case. Perhaps both of you might have a short comment on that, Sandra.
I mean, the classic example I just gave about Russian ruble is playing out right in front of us. The bank market has dried up. The banks themselves are having problems with traditional credit lines that they used to have with each other are now being pulled. There's a bifurcation going on in the market between local banks and foreign banks, and we're seeing a migration of some of those positions. I'm not saying that they're necessarily corporate, but I think a small percentage of that may be actual corporate hedged positions coming through the banks, because we are seeing those positions in, as I mentioned, open interest, which means people are holding those positions. It's not like someone puts a trade on and it disappears the next day. These are held positions, and as I mentioned previously, we're seeing 4-year, 3-year, 4-year held positions. So clearly there is a stressed credit problem going on in the Russian ruble market, and it's being demonstrated by the fact that we've got so much of this long-dated stuff sitting on our books.
Or would that be one of the reasons you would go, or you use your policy which allows you to use futures and options to go into these marketplaces because of liquidity issues, or because of lack of supply issues, or even credit issues with potential finance providers?
Yeah, I mean, I'd say that certainly would be a case for exploring those markets. I mean, it tends to be that most of the challenges we have with these countries is actually getting the cash out of them, which is a different issue altogether. But certainly, there's examples where we were looking at harder currencies than.
One question, a last question I want to take off the board here, so hopefully bear with us, we might run a minute or two over. The other issue here is these are complex products. You mentioned the fact that you have to persuade, or rather you have to educate people internally. Is that something you think the Treasurers nonetheless should embrace and actually make it part of their job because of the value that they can bring?
Yeah, I think there's a tension there. I mean, on the one part, I think most sort of treasurers are sort of forward-looking by sort of nature. They're sort of looking at sort of new ways that they can sort of manage the risk, the technology, etc. So I don't think we are closed, per se, to innovation. But then you've also got to sort of balance that against, well, if you put something in and you recommend it, where's the risk-reward going to fall? How much? Where do you invest your effort and time? And I think there needs to be some sort of demonstration or sort of perception that you're going to get a payoff sort of from that. And so I think that's the other challenge. If other corporates haven't tried it first, then are you going to want to be the first one to innovate? And I think that's a challenge. Once you start to see it become more mainstream, then the take-up will accept.
Sandra, would you like to make a final comment on that?
Yeah, I mean, just finally, I would say this is a long game, and exchanges traditionally, we've been around, futures have been around for over 40 years. This is a long investment we're making. We believe in it clearly. We're going to get better products out there that are going to be more conducive to corporate treasurers, but we believe it's also an education process. So it's worth knowing what it is, what are your options, and does it make sense for you. And the beauty of exchanges is that we can help you as well, because we will not be greedy about showing you materials and education. We will have materials ready for you and actually try to help you every step of the way if possible.
Paul and Sandra, thank you very much for your time this afternoon. I'd like to point out to everyone listening that the web platform will be open for about 10 minutes or so. There's a short survey which we'd be very appreciative if you would be able to finalize that for us. So it'll be open for about 10 minutes or so. I'd like to thank, obviously, CME Group for being sponsors of the webinar today. I'd also like to remind listeners that the webinar itself will be available from early next week. So if you have colleagues who did want to listen in but haven't been able to get online today, they will be able to do so early next week visiting treasurers.org. I'd also like to remind you that also on treasurers.org there's a list of future webinars and live events that the ACT runs on the website, and also on one of the slides that should now be in front of you as well. So I'd like to thank once again Paul and Sandra for being with us this afternoon. Thank all of you online for listening. If we weren't able to get to your questions, I'm sorry, but if they're relevant or if you have further questions, please do come back to us at the ACT and we'll try and make sure they get answered as best as we can. Thank you very much for listening and good afternoon, everyone.